one of the most important questions is just what are your goals? What do you want to do with that money? And I think that really helps put some not only perspective, on stocks and on returns, but also really it's going to help motivate you to invest. And what I mean is everybody's got their goal of $1 million by the time they retire, right? Or such and such amount. It really means nothing. I mean, just having some arbitrary goal of having $1 million by the time you retire is not going to motivate you when stocks do start falling or when the budget gets tight, right? So what I need people to do is take their goals in retirement or their goals for the money.
You're listening to the Rich State of Mind Show, the podcast made to make you the total package in the entrepreneurial world and give you what we call a rich state of mind. If you are here looking to learn about real estate investing, marketing, elevating your business, and developing your mindset to get to the next level, then you are at the right place. Stay tuned and be sure to join our community on richstateofmind.com. Now here's your host, Anthony Ritchie.
Hey everybody, welcome to an episode of Rich State of Mind where I'm talking to Joseph Hogue. He's graduated from Ohio State after serving in the Marine Corps. He worked in corporate finance and real estate before starting a career as investment analyst. He has appeared in Bloomberg and in CNBC and led a team of equity analysts for a venture capital research firm. He holds a master's degree in business and the chartered financial analyst designation. So Joseph actually decided to leave the corporate world in 2014 to build his online businesses, first through creating websites and later through his YouTube channel, Let's Talk Money. He's since grown pretty much like huge over 550,000 subscribers and has reached more than 1.8 million people in a month through blogs, YouTube, and weekly market newsletters. I think you'll like this episode because we talk about the bear market. We talk about what you need to invest in, what are safe, the difference between gambling and actual research investing. And Joseph breaks that down very well. So as always, thank you for listening. Please enjoy. Hey, Joseph, thanks for taking the time this evening on Rich State of Mind podcast. If you could please just tell us a little bit about yourself and what you do.
Sure. Well, thanks for having me. Really my pleasure. Come from an equity analyst background. So I've worked in venture capital as well as private wealth management. Did that for about 10 years as well as freelance equity analysis. And in 2014, really, decided I wanted to run my own business, really build those own assets of my own. So I started in blogging, started the YouTube channel, Let's Talk Money there in 2017. And it's just been great. It's been great being able to connect with regular investors rather than just, that top 1%, the private wealth investors that I was used to with venture capital and private wealth management. So I love talking about stocks and, really helping people understand stocks and the stock market.
Do you feel like more people are now educated on stock investing over these last few years than prior to?
Well, there's definitely more investors, and it's great that the pandemic and everything around it brought more people into investing because there's no better way to grow your wealth and grow your money. I feel like there's a lot of misinformation also, though. Basically, it was a one-way ticket for stocks, right? So I think a lot of investors have been kind of spoiled into that idea that stocks only go up, and you can invest in some of these meme stocks and these hot stocks that are going to make you rich, and that's not really how investing works. I've been investing since 1999, which of course was a great year to start investing because we all know what happened the year after that. And I think it's really relatable to a lot of the people that just started investing over the last couple of years because now they're seeing their portfolio in the stock market crash. And really the same experience I had in 1999. So I think it's great that a lot of people are investing. They just need the right information on what investing is really about and how to grow that over the long term.
Yeah, and I think it's interesting how we forget very quickly about certain things like, 2008 to be even a little bit sooner, or even like maybe March of 20, right? That time frame, things kind of got cut in half, and those emotions that we go through, right? We have to sometimes pull ourselves back. There's endorphins that are spinning like, oh man, look at that thing going up. I know a lot of people checking their Robinhood account, like seeing everything just going up, whether it was a meme coin or just, or Bitcoin or anything that, gains some type of credibility and high positive volatility during that time frame. I can
Sure.
very well see how people are very spoiled. But I think this is the opportunity to really get some real education on how to properly invest and not gamble, because I think there was a lot of gambling going on.
There was, and it happens all the time. And to a point, there, it's almost like a rite of passage, right? That all investors kind of have to go through. I went through it, and all the money, all the mistakes I lost, or the mistakes I made throughout that journey. It's great when you can share those experiences and help people not make those same mistakes. But yeah, a lot of times it's just kind of the mistakes we all have to make to learn from, right? I mean, you're in the military just as well as I was. We know that the best discipline comes from pain, right? The best lessons always come from pain. So right or wrong, that's just how a lot of investors have to learn sometimes.
Completely understandable. And so, since we're talking about education, what are some proper things that people should be looking at or questions they should be asking prior to investing in stock?
Sure. One of the most important questions is just what are your goals? What do you want to do with that money? And I think that really helps put some not only perspective on stocks and on returns, but also really it's going to help motivate you to invest. And what I mean is, everybody's got their goal of $1 million by the time they retire, right? Or such and such amount. And it really means nothing. I mean, just having some arbitrary goal of having $1 million by the time you retire is not going to motivate you when stocks do start falling or when the budget gets tight, right? So what I need people to do is, take their goals in retirement or their goals for the money, whether it's tuition or buying a house or whatever it is, and build a real story around that. Actually go in and think about what you're going to be doing every day in that new house that you own, or in retirement, where are you going to be living? Who are the people around you? And what are those emotions like? And really create that mental picture. And what that's going to do is, one, it helps you understand exactly how much money you're going to need to satisfy those goals, right? So it helps you plan a lot better. But also, more importantly, it's going to help motivate you because, when the budget does get tight or when stocks do start falling and you get worried about your portfolio, you can take out that mental picture and use it to motivate you to just keep investing, keep saving, and keep on that path to that goal. I think that's one of the most important things, and one of the things that most people forget to do really with investing.
Yeah, because I think people do it on YouTube, Google. They want to go straight to how to make $1,000 in a month from investing in
Sure.
stocks, right? So we want to get straight to the money, straight to figure out how to do it analytically versus internally identifying what best suits us. For most people, $1,000 would be great, but does it meet your end goal? Or is this going to kind of get you by? And this is supposed to be a long-term thing, unless I guess even for day traders, I feel like that's still something you intend to do for a long period of time to see some gains and live off of it and have a, build up your experience in that.
Sure. Part of what I like about building that goal and really understanding it is that I think it helps a lot of people realize, how modest returns they really need, right? If you're just saving, 100, maybe even $500 a month at the most, what kind of a return you need to actually get to that portfolio size or those financial goals can usually be very, very modest. Something like 7 to 9% really is enough for a lot of people. And so I think when they realize that, then they can step back and say, okay, you know what? I don't need to spend 10, 15 hours a week trying to find that next hot stock. I don't need to stress out about, being on that next big trend or that next big theme in the market. I can just, fill my portfolio up with just a handful of stocks that I really like, that I can be in for the long term, not have to worry about them, and still get that, 7 to 9% annual return and just be great with that, to those long-term goals.
Do you ever recommend a certain amount that people should be investing, like a certain percentage amount they should be investing out of their take-home pay?
Not really. I think it's kind of arbitrary. You hear that you should be doing 10% or 20%, or you should be doing a certain amount. And I think it keeps a lot of people from starting investing because they think, okay, you know what? If I can't invest 10% of my money, then what good is it going to do anyway? Or if I can't invest $100 a month, what good is it going to do? The most important thing is just people just get started, right? Even $50 a month over the next 20 years will grow to over $100,000. And so, yeah, it's not gonna make you rich, but it's gonna be a great nest egg, even if you start later in life. So I think people do need to start with whatever they can, build up that habit of saving every month and figure out what they actually want to do with it, because I think that's going to guide them a little bit better on how much they need to invest rather than just using some arbitrary number you get online about, 10 or 20% of their income.
That's the first time I've heard it explained that way. And you're right. It is kind of daunting. Like, all right, 10%. What is that?
Oh yeah.
That's 4,000. That's $400 a month. That's a lot of money.
Yeah, especially just starting out. I mean, if you don't have that habit of saving and that habit of investing, then to think that you need to start with $500 or $600 or $400 a month, then why even bother? So a lot of people just don't get started, and it's too bad because time is really your best friend in investing. Heard a statistic a couple of weeks ago now. It was Warren Buffett. Okay, obviously everyone knows Warren Buffett, one of the one-time richest man in the world, still doing pretty well, even though he's not the richest. I think he's somewhere over $100 billion net wealth. He has made, I think he's about 85 right now. He has made more money since he was 65 than he made in the 50 years before that investing. Right. He has made, he started, something like he was 14 years old, bought his first stock, invested for 50 years there and did very well, got very wealthy, but he has made more money just in the last 20 years than he made in the entire 50 years before that. And why? It's because, that time effect. That compounding interest, making money on your money. When he retired, or when he hit 65, he had something like 50, 60 million, $60 billion. Well, even if you earn just 10% on $60 billion, that's $6 billion a year you earn, right? Obviously, he didn't start off doing that though 60 years ago, 70 years ago, but he's built that over time. So yeah, just get started. Start with $50, $25, $100, whatever you can each month, and build that over time. And you will be amazed in 20 years how much you are making off of that portfolio every month just on the returns.
So, speaking of returns, obviously we're not seeing the returns that we're used to in these last couple of years lately. We've basically have entered that bear market with somebody putting together their goals of what they intend to do. How do they make sure they stay sane during a bear market?
Sure. Well, I think the most important thing is just change your perspective. Yeah, it always amazes me how people love to invest and push more money into the stock market as prices are going up in that bull market, but then they freak out, they panic sell, and they get scared and leave the market when stock prices are coming down. And it should be just the opposite, right? As prices are going up, you never know when that's going to be the top. You never know when that's going to be it for the next couple of years.
Yeah.
But as prices start coming down, you're getting a discount. We are now at 20% down from the peak in the S&P 500, so that broad stock market index. And so you're getting a 20% discount, 20% off of where stocks were just 6 months ago. You go to any store and they say 20% off, and your eyes, your ears perk up and your eyes are
Yeah.
right? Why don't people do that now with stocks? So yeah, just change your perspective. This is a great time to invest, great time to start investing, right? Because you're getting that discount. Another thing that I think will help people is just to keep investing and or keep saving. And I don't know that necessarily means put all your money in stocks all at once, because I do think stocks will fall further into 2022 because we are heading kind of towards a recession. But keep that habit of saving, and putting money in your investing account every month, whether it stays in cash or whether you invest in stocks, just keep that habit of saving. Because what I see too often is people stop investing in stocks because stocks start coming down. They take that money out of the investing account, or they just stop saving entirely. And of course, we all know our expenses tend to rise to meet our level of cash flow, right, or our level of income.
Yeah.
So if we're not saving, your expenses are just going to magically increase somehow to cover that, and you're going to be at zero every month. The problem here is when you do want to start saving again, when stocks start rising and start making everyone rich once again, then you're going to look at your budget and you're going to go, oh shit, what happened? Now I don't have any money. I can't save it. I can't save any money each month because, my expenses are so much higher now. So just keep that habit of saving, even if you're not investing in stocks. put it in cash or some of the other investments, the safe investments we can talk about, and you'll be better off for it.
And so how long, one thing I meant to ask you, let's just say bear
Sure.
market 101, what causes a bear market? And then
Sure.
how long does that usually last,
Sure.
historically?
Well, there's typically three things that cause a recession or a bear market in stocks, and they're not exactly the same, but they do tend to follow each other pretty closely. One is the Federal Reserve increasing interest rates, so that's the central bank of the United States. They really control, or they try to guide the economy because they have two things they have to do, just two rules the Federal Reserve has to live by. One is low inflation, and two is, a good jobs market, so low unemployment. And those are it's kind of a balancing act, right? Because when you have, really low unemployment, everyone has jobs, everyone's getting raises, then that kind of spurs inflation, right? That drives the economy and drives prices higher. So they kind of have to raise or lower rates to balance that. What the situation we find ourselves in now with inflation at 40-year highs, they need to slow down the economy to slow down that rise in prices, right? So they start raising interest rates, they start raising the cost of borrowing, and that slows down the economy. It slows down, it brings stock prices down, things like that. So that's one, and that's really the most common thing that pushes us into a bear market or a recession. The other things are things like commodity price shocks, like the oil embargo back in the 70s, lots of oil price shocks, often something we saw earlier this year with when Russia invaded Ukraine, and that oil price shock, the food price shock with the grains coming out of that region. So that's another one. And typically, once the data we have going back to the 1930s, typically a recession or a bear market will last anywhere right around 9 to 11 months. So they are fairly short. They do tend to be fairly short when they get started. And then the bull market, so when prices do start rising again, those tend to last about 54 months. So much longer. The pain is very concentrated, usually very focused,
Yeah.
and something a lot of investors, if you keep that perspective of you're getting a discount in stocks, it's something you can live with for 9 to 11 months.
And so what type of stocks should I be looking at? Should I be looking at, okay, maybe some type of staple stock, some type of anchor stock that's going to weather the storm and maybe not so volatile? Should I be shifting, or should I be like, hey, I'm just gonna take it? Amazon shot down a lot, right? So I'm just
Sure.
gonna invest more into Amazon, or should I be shifting a little bit of that over?
Yeah, and for a lot of people, and the easiest thing you could do is just not worry about it. Just keep on that goal of those long-term goals you have,
Mhm.
investing in those long-term companies you have. Amazon is actually a great choice because it is a very strong, very safe and stable company. The price has come down quite a bit, so you're getting that great discount on shares right now. And yeah, just have a handful of 10, maybe 15 individual companies that you really like. Invest in those no matter what every single month, and you'll do very well over the long term. One example I love to give is Amazon. In fact, IPO'd in 1997, right towards the peak of that dot-com bubble. Reached about it was $100 a share in 1999, right at the peak. In the crash, fell 95%. Okay, this is Amazon now. Okay, what would become the largest e-commerce company in the world lost 95%, down to about $5 a share, $5.60 a share. By 2002. And of course, we know what's happened since then. Just earlier this year, it was at $3,500 per share before the split, okay, which would have been a 500 times your money. Okay, so
That's
so being able to keep that perspective and just invest for the long term, not getting worried about the stock market crash or what stock prices are doing, but investing every single month, you would have earned 500 times on your money. Could have turned $1,000 investment into $500,000 in just one stock. Have those 10 to 15 stocks that you really like. I always recommend having three to five exchange traded funds. So just funds, funds of stocks as well, just to kind of diversify and spread out your risk across the stock market and across other assets. But yeah, just a very simple portfolio that you can invest in, every month, no matter what. That works for 99% of the people out there. Simple, stress-free. I don't even have to worry about it. For those that do want a little bit more stock picking, a little bit more fine tuning, then yeah, you could shift a little bit more towards the stocks that tend to do better during a recession. You've got things like consumer staples, which are your food processors, your packagers, household goods, things like that. The electric and gas company. pharmaceutical stocks, so drug makers do very well. Auto parts stores actually tend to do pretty well in a recession also. And of course, these are all things that you tend to buy whether the economy is growing or not, right? If people need their heart medication whether stocks are falling or not. Okay, and maybe even more heart medication. People are going to be smoking or buying alcohol or by drinking Pepsi or Coke whether the economy is falling or not. These are the kind of the companies and the kind of stocks that very dependable cash flows and very dependable stock prices.
I never would have thought, something like auto parts or
Yeah.
auto service companies would be, but you're right. People need their
It's
cars.
surprising that dollar stores and I mean this is all from research. I did research on the 2007 from October 2007 when the stocks hit their peak to March of 2009 when the market hit its low. Market fell about 55% during that period. And yeah, we see a lot of the auto parts stores, a lot of the dollar stores and discount stores for kind of intuitive reasons. If people are cutting back their spending, they're going to go to where they can get the biggest discounts. But if people are not buying new cars, then they're going to be fixing up their old cars. So that really drove those auto parts stores very well. It's not to say that these stocks, consumer staples, utilities, all these stocks, it's not to say that they're not going to see some losses. And we have seen, a drop off in some of these stocks, but they tend to fall less than the rest of the market just because they have a little bit more stable cash flows and that kind of thing.
That reminds me during COVID how Lowe's and Home Depot was getting a lot of business because people were stuck at home and doing home repairs or home improvements.
Yeah. There's trends that you can follow, kind of some of the longer term trends in artificial intelligence, in self-driving, trends like that really have those big picture ideas and forces behind them that should drive those stocks, over the next 10 or 15 or 20 years even. So really kind of trying to take the market crash out of those stocks and out of your portfolio and just investing for that long term. It's another great strategy.
So I've been looking into companies that do 3D printing. I've done some research on that for my degree, and 3D printing. I remember when you growing up, if you had a household would have one computer and maybe one printer. Right now we've got a bunch of computers, whether it's our phones or our desktops. And then now the future, I believe, is 3D printing will be a commonplace. And the idea is that you will, instead of, let's say I buy something from Amazon and it's delivered to my doorstep, I buy something from Amazon and it's printed out of my 3D printer, as long as I have the materials. Now, how that process is going to go, I don't know, but that's just my thought. From what my research is, I've been looking into companies that do that either fund that, create them.
Yeah, it's amazing what these 3D printers can do now. As long as you've got the material to go into it, I mean, it can build spare parts for anything you need, as well as just parts that you would normally buy and have them shipped. You can just print them right there at home.
Yeah, and they're actually building homes now too, 3D printing homes.
Wow.
And so hindsight's 2020. We talked about like 1999, talking about 97 with Amazon. Going back to 99 when you started investing, if you could go back in time, the age you are now, and talk to your younger self, what would be some things you would have told that younger Joseph?
Wow. Yeah. Don't, I mean, one of them would be, don't get caught up in a lot of these hot stock trends, right? Or the trend of the moment, or momentum investing. Momentum investing, I think is a big one just this last couple of years as well, where it's great to think that a stock is going to make you rich overnight, or that stocks always go up. And, in stocks that you really know about, you've done your research and you really think it's a great company, investing only because they've gone up. Okay. We've seen a lot of that over the past couple of years, investors chasing those stocks with the highest returns, thinking that those are always going to be the ones with the highest returns. And of course, those are also the ones to fall the hardest when the stock market crashes. We've seen, 80, 70, 80, 90% sell-offs in a lot of these stocks just over this last year. So, stick with those great long-term companies, those great long-term stocks. That would be one of them. Another would be to diversify a little bit, not just have all stocks in your portfolio, right? Have some bonds, have some real estate as well. That's really going to help smooth that ride out a little bit. When stocks do start falling, then you're going to have those bonds to pick up the pace a little bit. You're going to have real estate to help you fight inflation as well.
Yeah. And so speaking of bonds, I know you have some favorite investments currently right now. What are those favorite investments right now?
Sure. Well, bonds haven't done great this year, but they still have protected people's portfolio. If you look at something like the Vanguard BSV, the short term bond fund, that's ticker BSV. It's I think it's down maybe something like 5% this year so far against stocks that are down 20%. So it has helped protect you from the worst of that stock market crash, and it tends not to fall quite as hard when interest rates go up. Really, that's why a lot of bonds, lately have been falling because as interest rates go up, those older bonds are worth less. So bonds can still protect your portfolio. I like that BSV fund. One of the best opportunities though is in the Series I savings bonds, right? So it's not necessarily a corporate bond, but a savings bond issued by the government. These are adjusted every 6 months depending on the rate of inflation, right? So obviously with 40-year highs in inflation, the interest rate you're getting on these is just through the roof. These have been around since 1998, but really just started paying these great rates over the last year, paying 9.6% right now. And you're limited to $10,000 is how much you can put into these, how much you can really protect. But you can max out that limit for anyone with a social security number, as well as any company with an EIN, with an employee number, identification number for taxes. So I've got the 10,000 in my account, my wife's, our two kids, and it's really a great way to not only protect your money from further stock market weakness, but still earn that return. Still earn what is right now a 9.6% annual return, which is just an amazing return for any kind of a guaranteed safe investment.
Yes.
Now you are locked into that for at least a year. As a savings bond, you have to hold your money in there for a year. If you sell within, between that 1 year and 5 years, so if you sell before 5 years, you give up like 3 months of interest. Really 10% a year. 3 months of that is almost nothing. And I think we're going to need that kind of stock market protection for at least another year. So 9.6% is just really too good to pass up for a guaranteed safe investment.
I agree, especially when something's guaranteed. And when I hear you say, we're going to probably need that for at least a year, I know that's going to feel like an eternity to people that were so used to things going up. I spoke to you earlier before we started recording how I'm really big on real estate investing. And so I've been kind of looking. I still want to buy actively because you still can find deals, but even we're starting to, like you talked about the interest rates, right? I'm getting like 7% interest rate, for my investments. And it's, like I said, if the numbers make sense, then fine, but definitely seeing the correlations between the two. And but you're right, inflation was great, and it definitely helped a lot as far as the appreciation of our homes. It helped in that part. So there's pros and cons, obviously, how this goes. And then I believe that nobody's at a complete loss. It's just you have to pivot. The market just makes you pivot and decide a new strategy in order to continue to succeed. And I like it. I know a few people have mentioned, we're going to see who the real idiots are now. They're all going to be exposed now. But I like to mostly think about this as just a lesson to learn that I don't see. It's not the worst. I've seen bigger drops in my lifetime from what's happening. So I think this is a good lesson to learn. Everybody, do your homework now, really become a real investor, or just get out with your Dogecoin and, spend your money elsewhere.
Yeah.
Which is fine.
Yeah, like I said, sometimes it's just the hard lessons that you have to learn, right? That discipline that can only come from the pain of loss, and that kind of thing. And you're right. So stocks fell more than 50% in on the dot-com burst, fell 55% in 2007 through 2009. We're only down 20% on the broader market index right now. Of course, obviously some of those hot stocks and those trending stocks are down 60 and 70 and 80%. But so it's just the lesson a lot of people have to learn. It's better that you be honest with yourself, what you're investing in, and learn that lesson now rather than continue to make that same mistake over the next 20 or 30 years, right? If you can learn that lesson now, and really put your portfolio back on track and, pivot when you need to, and make those smart investing decisions, then this is going to be a fading memory when you're when you're cashing those bigger checks in with your financial goals.
Exactly. You're exactly right. Actually, it's going to be like, oh man, I was stressing out during that time frame.
Yeah.
And so I always like to ask everybody this: what is your rich state of mind? What's your big why? You have over 560,000 subscribers on YouTube, so you're clearly doing this with intention, with passion. But the question is, why? Why are you doing this?
Sure. Well, I think it's just because I worked for so long, only being able to work with kind of that 1%, right? Venture capital, you have to have over $1 million net worth or some like $250,000 net income a year to invest in venture capital. The private wealth management clients that I worked with, those had to be accredited investors as well. So I just spent so much time, really being restricted on who I could talk to with investments and that kind of thing. It's refreshing. It's great to be able to talk to Main Street investors, regular investors. I mean, that's where I come from. So it's great being able to share that experience with regular investors and help them really with the same analysis and the same insight that I was able to bring to the wealthy and that 1%.
It's appreciated, and you save people a trip. What used to be for a lot of people, I'll say 15 years plus, a trip to the library, right? To pick up a book and read it, and probably hundreds of pages before they get to the answer that they needed, which was on your 10-minute video on YouTube. So I do appreciate your service in that way, educating a lot of people, millions of views on that. And I've been looking at your stuff. I remember Bowtie Nation. I definitely remember that. And cool. You found a cool little way to connect with your fans too, as well. So again, man, appreciate you being here. I think it was great insight. Help people not be so stressed out about this bear market. It's not the end of the world, not Armageddon. And then, like I said, just pivot into a strategy and identify and map out that strategy to be successful. I think it's going to be pretty cool.
Definitely. It's my pleasure.
Thank you for sticking with us from the start of the episode. Please share our show with friends and family, visit our YouTube channel, and view more of our content on richstateofmind.com. See you next week on the Rich State of Mind Show.